There is a theft happening right now, and most people cannot see it. Every single day, wealth is being transferred from one group of Americans to another, not through taxation, not through legislation, through a mechanism so subtle, so silent, that its victims never realize they are being robbed. So you have money sitting in a savings account, a checking account, or certificates of deposit. You are on the wrong side of this transfer. And 2026 is the year when ignoring this reality will cost you dearly. This is not speculation. This is not fear-mongering. This is the logical consequence of forces that have been in motion since March 2020, forces that have already reshaped the financial landscape of America. The data tells a story that few are willing to hear. Between 2020 and 2022, approximately 40% of all dollars in existence were created. Think about that for a moment. More than 240 years of American monetary history surpassed in just 2 years. The consequences of that decision are still unfolding, and today you will understand exactly what those consequences mean for your wealth, your retirement, and your financial future. And it starts with a dangerous illusion, the illusion of safety. Most Americans believe that keeping money in the bank is the safe choice, the prudent choice, the responsible thing to do. This belief is wrong. And in 2026, it is not just wrong, it is financially devastating. Here are the numbers. The national average savings account yields 0.39% annually. Current inflation runs at 2.7%. That means every dollar sitting in a typical savings account loses approximately 2.3% of its purchasing power every single year. That is not safety. That is guaranteed destruction of wealth. But the headline inflation number of 2.7% dramatically understates the real damage. When Harvard economist Larry Summers calculated a cost of living measure that includes mortgage interest and auto loan payments, the effective rate approached 9% in late 2024. Consider what you actually pay for. Grocery prices have risen more than 27% over the past 5 years. Housing costs contributed 58% of all inflation in 2024. The shelter category alone comprises 36% of the entire consumer price index. The official inflation number is a statistical construct. The prices at the grocery store, at the gas station, at the hospital, those are the numbers that determine whether you can maintain your standard of living. And here is what most people miss entirely. The cumulative damage never retreats. When inflation peaked at 9.1% in June 2022, that was a 40-year high. But when inflation declined to 2.7%, the prices did not decline with it. Everything that doubled in price stayed doubled. The $100 in January 2020 now requires $125 to purchase the same goods. That 25% erosion of purchasing power represents the largest wealth transfer in a generation. Federal Reserve Chair Jerome Powell acknowledged in December 2025 that many households still grapple with embedded higher costs from 2022 and 2023. That is a tacit admission from the central bank itself. The damage is permanent. But understanding why this happens reveals something even more troubling. Cantillon Effect. In the 1730s, an Irish-French economist named Richard Cantillon identified a pattern that explains precisely how inflation transfers wealth. His observation was simple but profound. When new money enters an economy, it does not distribute evenly. It follows a predictable path. And that path systematically enriches some while impoverishing others. Here is how it works. When the Federal Reserve creates money through asset purchases, that new money enters the financial system at the top. Banks receive it first, large financial institutions access it second, major corporations tap it third. These first recipients can acquire assets, stocks, real estate, commodities at prevailing prices before inflation arrives. By the time the new money reaches workers through wages, retirees through cost of living adjustments, savers through interest payments, prices have already risen. The first recipients buy assets cheap. The last recipients pay inflated prices. This is not a bug in the system. This is how the system works. The Federal Reserve's pandemic response perfectly illustrated this mechanism. The Fed's balance sheet expanded by approximately $4.5 trillion. Direct stimulus payments to American households totaled roughly $400 billion, more than 10 times less. The injection point for Fed purchases was at the pinnacle of the financial system. The injection point for stimulus checks was at the base. The results were predictable. Federal Reserve data reveals the distributional consequences with brutal clarity. The top 10% of Americans now own 93% of all equities. That is an all-time record. The top 1% owns 54% of public equity markets, up from 40% in 2002. The bottom 50% owns just 1% of all stocks and mutual funds. Between March 2020 and October 2021, combined American billionaire wealth increased 70%, from $2.95 trillion to $5.02 trillion in 19 months. July 2024 Federal Reserve Bank of New York study reached a stark conclusion. While inflation hurts everyone, it hurts the poor in particular. The research found that the distributional impact is U-shaped. The bottom 1% of households are affected almost twice as badly as the top 1%. This is not class warfare rhetoric. This is Federal Reserve research. And the numbers driving this transfer forward are staggering. The mathematics of the debt spiral. As of January 2026, the United States national debt stands at $38.43 trillion. It grows at $6.17 billion per day. That translates to $71,462 per second. The debt to GDP ratio has reached approximately 100%, approaching the all-time record of 106% set in 1946 after World War II. But there is a crucial difference between then and now. After World War II, primary budget surpluses and declining military spending enabled debt reduction. Today, the United States faces structural deficits with no resolution in sight. Annual deficits run approximately $1.8 trillion, representing 6% of GDP. That is roughly double the 50-year historical average of 3.8%. But the interest payments tell the most alarming story. Fiscal year 2025 net interest reached $970 billion. For the first time in American history, interest payments surpassed defense spending. Interest now consumes nearly $1 in $5 of federal revenue. Interest expense has nearly tripled in just 5 years, up from $345 billion in fiscal year 2020. The Congressional Budget Office projects interest payments will reach $1.8 trillion annually by 2035, consuming 22% of all federal revenues. Consider what this means structurally. More than 80% of projected spending growth over the next decade comes from just 3 areas: Social Security at 28%, federal health programs at 32%, net interest at 22%. These are mandatory expenditures. They grow automatically regardless of political will, and they virtually guarantee continued monetary accommodation, which historically erodes cash holdings. History has seen this pattern before. The warnings from history, the 1970s Great Inflation lasted nearly 2 decades, from 1965 to 1982. Inflation progressed from 1% in 1964 to exceed 14% by 1980. Resolution required Paul Volcker raising the federal funds rate to 19.1% in June 1981. This triggered a severe recession with unemployment peaking at 10.8%. The medicine was painful but necessary. The S&P 500 returned just 17% nominally for the entire 1970s decade. After adjusting for inflation, stocks lost nearly 50% of their real value. Price-to-earnings multiples compressed from 20 times earnings to just 7 times. Even as corporate earnings tripled, bond investors fared even worse. Real after-inflation returns on 10-year treasuries totaled negative 33% from 1966 to 1979. An entire generation of savers watched their purchasing power evaporate. But the winners were clear. Gold rose from $35 per ounce to $850, a gain exceeding 2,200%. Energy stocks delivered 73% real returns during the stagflation period. Farmland appreciated 14% annually. Those who understood the dynamics early protected themselves. Those who clung to traditional definitions of safety, certificates of deposit, savings accounts, government bonds, discovered that their definition of safety was actually the greatest risk of all. Weimar Germany offers an even starker warning. Between 1921 and 1923, the German mark collapsed from 4 marks per dollar to 4.2 trillion marks per dollar. As economists have noted, at the end of World War I, you could have bought 500 billion eggs for the same money needed 5 years later for just 1 egg. And the mechanism was the same as today: excessive money creation to finance government obligations. The scale was different, but the principle was identical. Contemporary examples reinforce the pattern. Argentina experienced 211% inflation in 2023, the highest in 3 decades. The peso devalued 54% in December 2023 alone. Argentinians protect wealth through dollar savings and real estate transactions conducted entirely in cash dollars. Turkey has seen the lira decline 81% versus the dollar over 5 years. Even at 45% interest rates, Turkish savers lost money to inflation exceeding 67%. Gold demand in Turkey has exploded. The country now accounts for 17% of global gold bar and coin purchases. The universal pattern across all episodes is clear. Cash is devastated. Gold shines brightest during currency crises. Real assets provide partial protection. Resolution always requires painful adjustment. Which brings us to the only reliable defense, pricing power shield. Warren Buffett stated it plainly. The single most important decision in evaluating a business is pricing power. If you have the power to raise prices without losing business to a competitor, you have a very good business. Buffett described inflation as a far more devastating tax than anything enacted by legislatures. He warned that inflation has a fantastic ability to simply consume capital. Pricing power derives from economic moats, sustainable competitive advantages that allow companies to pass cost increases to consumers without destroying demand. Morningstar identifies 5 sources of these moats: cost advantage, as demonstrated by Walmart; intangible assets like brands and patents, as demonstrated by Starbucks and pharmaceutical companies; network effects, as demonstrated by Google and Visa; switching costs, as demonstrated by Apple's ecosystem and enterprise software; and efficient scale, as demonstrated by utilities and railroads. Recent inflation tested these moats in real time, and the results were instructive. Procter & Gamble raised prices 10% year over year in the first quarter of 2023 across 90% of core product categories. They experienced only a 3% volume headwind. Consumers paid more and kept buying. Coca-Cola increased average selling prices by 11% in 2022, its biggest increase in history, with minimal demand destruction. Apple's gross margin improved from 38.2% in 2020 to approximately 47% by 2025, demonstrating the power of ecosystem lock-in. Companies without pricing power face a different reality. They absorb cost increases, watching margins compress, or they raise prices and watch customers flee to competitors. Either path leads to diminished shareholder returns. The distinction matters enormously for your portfolio. Companies with genuine pricing power compound wealth regardless of the inflationary environment. Companies without it become victims of the same forces eroding your cash holdings. But pricing power is not the only protection available. Building real protection, gold has been the standout performer since March 2020, rising approximately 98% and reaching record highs above $4,000 per ounce in late 2025. Central bank purchases hit a record 1,045 tons in 2024, the third consecutive year above 1,000 tons. Gold ETF inflows totaled $21 billion in the first quarter of 2025 alone. JP Morgan projects gold could reach $5,000 to $6,000 per ounce by late 2026 or beyond. Thoughtful advisors typically recommend 5 to 10% portfolio allocation to gold, not as a speculation on price appreciation, as insurance against monetary uncertainty. For more than 2,000 years, gold has maintained relatively stable purchasing power through political crises, wars, and regime changes. Real estate investment trusts offer another proven hedge. REITs have delivered 12.3% average annual returns over the past 25 years, compared to 10.2% for stocks with lower volatility. During high inflation periods specifically, REITs average 8.9% returns compared to 6.5% for stocks. The mechanism is straightforward. Property values and rents rise with inflation, providing a natural hedge. Data center REITs are particularly favored currently due to artificial intelligence-driven demand. Dividend-paying stocks deserve careful attention. Dividends have accounted for 40% of total stock market returns since 1930. The 69 S&P 500 dividend aristocrats, companies with 25 or more consecutive years of dividend increases, have typically grown dividends 5 to 6% annually, consistently outpacing inflation. The power of dividend compounding over time is remarkable. Coca-Cola now delivers a 63% annual yield on Berkshire Hathaway's original cost basis. American Express delivers 37%. These yields would have seemed impossible at the time of purchase, but decades of consistent dividend growth created extraordinary income streams. For direct inflation protection, Treasury inflation-protected securities offer approximately 2% real yields on the 10-year. Series I savings bonds offer a 4.03% composite rate through April 2026. The annual purchase limit of $10,000 per person constrains the utility of I bonds for larger portfolios. TIPS face no such limitation, but understanding the cost of inaction matters most. The mathematics of inaction. Consider what happens to $500,000 sitting idle over time at 3% annual inflation, which is below current levels. That $500,000 retains only $412,000 of purchasing power after 5 years. After 10 years, only $340,000. After 20 years, only $231,000. You have lost more than half your wealth without touching a penny, without making a single investment mistake, simply by choosing perceived safety. At 5% inflation, which remains plausible given fiscal pressures, the erosion accelerates dramatically. That same $500,000 retains only $391,000 of purchasing power after 5 years. After 10 years, only $307,000. After 20 years, only $188,000. For someone planning retirement, this is not an abstract calculation. This is the difference between comfort and hardship, between independence and dependence, between the retirement you planned and the retirement you can actually afford. The tragedy is that most victims of this transfer never understand what happened. They did everything they were taught was responsible. They saved diligently. They avoided risk. They kept money in the bank. And they watched their purchasing power systematically destroyed by forces they never saw and never understood. But you now understand what most never will. The clarity of understanding, the invisible wealth transfer, operates through mechanisms that most Americans never see. Negative real interest rates punish savers. Asset price inflation benefits the already wealthy. The Cantillon Effect channels new money to those closest to its creation. Cumulative price increases never retreat. The $38 trillion national debt growing by $6 billion daily virtually guarantees continued monetary accommodation. History shows clearly what that means for cash holdings. The data reveals patterns for survival. Companies with genuine pricing power preserve and grow wealth during inflation. Gold has consistently protected purchasing power during currency crises. Real assets like real estate and REITs provide natural hedges. Dividend-growing stocks compound wealth regardless of the monetary environment. Cash and bonds without inflation protection remain the most reliable path to purchasing power destruction. Perhaps most importantly, the 1970s and contemporary episodes in Turkey and Argentina demonstrate that inflation regimes can persist far longer than most expect. Those who position early benefit most from eventual normalization. Those who wait for certainty pay the highest price. The invisible transfer continues whether or not its victims understand the game. But you now understand, and understanding changes everything. The choice before you is simple but consequential. You can continue holding idle money and hope for the best, or you can act on the principles that have protected wealth through every inflationary episode in recorded history. History will once again be an excellent teacher. The only question is whether you will be among the students or among the victims. If this gave you something to think about, consider subscribing. We go deep on topics like this regularly. And if you found value here, a like helps more than you know. Until next time, stay sharp.